The good news for the back half of 2023 is that fixed income has its last name back, meaning yields are higher and real income can be earned. This 8-minute webinar will highlight the opportunities we see in the fixed income markets. Goodwood manages mutual funds, private limited partnerships, and segregated accounts for institutional and private clients. My name is Curt Cumming, and as usual, I'm joined by Currie, head of our fixed income investment team. Chris has invested in the fixed income market for over 25 years, including portfolio management positions at OMERS, TAL Asset Management, and as a corporate bond credit analyst at CIBC World Markets. The Bank of Canada recently raised its key interest rate for the 10th time since March 2022. As the effect of higher interest rates permeate through the economy, it is important to assess the relative risk and rewards associated with asset classes. Although an inverted yield curve can sometimes signal a recession, in the world of fixed income, this also presents investment opportunities. We believe corporate bonds will now do well with higher treasury yields and risk premiums. The dark blue bar represents expected returns in asset classes in June 2020. The lighter bar represents the same asset class's expected return last month. The market has clearly revalued fixed income. We believe the fixed income sweet spot is short-term investment-grade corporate bonds. With the inverted yield curve, investors can now generate guaranteed and elevated returns over 400% above what they were being offered 3 years ago. Chris, please elaborate why you focus on corporate bonds.
Thanks, Curt. We favor corporate bonds as an asset class for the following reasons. One, preservation of capital. Investing in a corporate bond is a legal contract to provide timely interest and return 100% of capital at maturity. There are legal remedies if interest or principal payments are missed. It is important to note that the safety aspect of corporate bonds is verified and graded by independent third-party rating agencies who produce graded credit ratings. Another reason is higher coupons. Investment-grade corporate bonds are always issued with a higher coupon than the equivalent term to maturity of Canada's. Higher coupons also provide portfolio cushioning to dampen portfolio volatility. Another reason is spread tightening, which equals capital gains potential. Spread tightening refers to yields falling relative to Canada's. Yields down, price up. Spread tightening can result from a company's prospects improving from such events as equity raises, asset sales, new profitable lines of business, etc. Credit rating upgrades. Credit rating upgrades are the ultimate validation of spread tightening that has occurred in the market. A credit rating upgrade leads to a wider universe of potential investors in the institutional universe. More buyers equal rising prices.
We manage 3 fixed income mandates for institutions and individual investors: an investment grade bond mandate, an ESG conscious bond mandate, and the award-winning the Goodwood Milford Fund, a credit-focused long-short mutual fund. Chris, what is the portfolio yield and the effective duration of these 3 mandates?
In the long-only investment-grade portfolio, the current average yield to maturity is 5.7%, and the average effective duration is 2.4 years. That gets extended a little within our ESG portfolio, where the effective duration lies around 3.2 years and has a portfolio yield of 5.5%. We are able to incorporate leverage into the Milford portfolio, which elevates yield to 8 to 9%.
Before I ask you about interest rate cycle and duration management, let's continue with why you focus on corporate issues. You've mentioned before that the investment-grade corporate bonds can also act as a hedge against inflation. When the economy experiences inflation, the value of cash and other fixed income securities, such as government bonds, may decline. However, the new issue investment-grade corporate bond coupons increase with inflation, which means that the purchasing power of an investor's capital could remain constant or even increase during inflationary times.
Bond investors expect the yield they receive to compensate them for inflation and also the amount of time they have their money on loan, commonly known as the term premium. Normally, you would see the inflation premium and the term premium reflected in an upward sloping yield curve. The really interesting challenge is forecasting future levels of inflation. Clearly, in today's marketplace, investors expect inflation to fall over the medium term. This is why investors are willing to accept lower yields for longer term bonds than they can get with short term bonds or floating rate notes.
I think fixed income investors need to consider tail risk in this environment of slowing economic growth and higher interest rates. The most vulnerable borrowers will be potentially exposed. Those companies that could survive at sub 1% interest rates, but may struggle at these higher rates of interest if we enter a prolonged recession. Do you think we're heading into a recession? How have you positioned the portfolios, and what tools do you have to protect capital?
Curt, we are forecasting a shallow recession as we don't see fiscal spending slowing down in Canada or the US. And as a result of that, we believe employment levels should remain strong and consumer spending should stay healthy. We have positioned our portfolio in this regard. In line with our forecast for a shallow recession in 2024, I believe two comments are relevant. If a potential recession is, as we forecast, at least 2 quarters away, we don't think now is the time to extend duration to try to benefit from a potential cut in rates that should occur if a recession is severe enough. With the inverted yield curve, we are seeing attractive income opportunities in the 1 to 3 year maturity tenor, where coupons can be north of 5%. We see the main change in portfolio construction would be to extend duration if and when we see weakness in the economy and the labor market. The onset of a recession and a concurrent rise in unemployment usually initiates a policy response by central banks of cutting rates. Rate cuts make existing higher coupon bonds more valuable. They're bid up in price, and that generates a capital gain. Last Wednesday, the Bank of Canada increased its target for the overnight rate by 25 basis points to 5%. In our view, the most important takeaway was that the bank is acknowledging that excess demand in the economy created by tight labor markets is impacting the forecast slowing of inflation. The bank now forecasts a slower rate of decline in inflation than previously. They stated that they expect inflation will hover in the 3% range through 2024. And our opinion is that strong employment and fiscal policies are frustrating the impact of rising rates. We forecast that short rates will stay higher than most forecasters expect through the next year. In that environment, we believe that high coupon, short-term investment grade bonds at 4.5% to 5.5% remain attractive investments.
On behalf of the entire fixed income team, thank you for listening to our update, and we look forward to keeping you current.